In my previous video, we looked at how Saxo Bank grew from a Danish brokerage firm into one of the Denmark's biggest fintech success story. But that leads to one question. If Saxo was already such a strong digital investment platform, why did the Safra Sarasin, a traditional Swiss private bank, decided to buy it? At first, answer looks simple: growth. But I think the real answer is deeper. Safra was not just buying bank, it was buying a glimpse of future wealth management. Let me explain this with a simple example. Imagine two different restaurants. One is the old luxury restaurant. The staff knows every customer personally. They remember your favorite table. They know what you like. They understand what your taste is, your family member, and your history. That is traditional private bank. It built on trust, relationships, and personal service. Now imagine another restaurant, the second restaurant. There is no waiter. Everything happen on a app. You order instantly, customize everything, track your order live, pay digitally, get recommendation based on your past choices. That is fintechs. Fast, digital, scalable, and data driven. For many years, these two worlds looked separate. Private banking was personal, fintech was digital. But today, clients do not want to choose one. They want both. They want the trust of a private bank and the speed of a digital platform. That is where Saxo Bank becomes valuable. Many people look at Saxo Bank and say it is an online trading platform. But Saxo is much more than that. It has technology, it has data, it has API, it has digital client access, it has infrastructure that can serve thousands, even millions of investors without one banker at every client. And in the future of wealth management, this kind of infrastructure may become important than traditional branches. Earlier, wealth management was mostly about relationship, a manager advising a wealthy client. That will still matter, but now the customer expect more. They want mobile access, they want faster execution, they want better reporting, and they want global market access. And very soon they will expect AI powered answer. For example, why did my portfolio fall this week? Am I taking too much risk? What happens if interest rates goes down? Can I improve my portfolio without changing everything? In the old model, a banker would prepare these answers manually. In the new model, technology and AI can support this much faster, but AI needs good data. It needs good system. It needs strong digital platform, and that is exactly what Saxo brings here in this deal. So from Safra's point of view, Saxo is not just an acquisition, it is a shortcut. Instead of spending years building digital investment platform from zero, Safra can get proven platform immediately. It gets technology, it gets digital infrastructure, it gets modern infrastructure, and most importantly, it gets access to the next generation of wealthy client. Because tomorrow's private banking client may not start inside a private bank, they may start on a digital investment platform. A young entrepreneur, a professional, or a founder may begin investing through Saxo. But today, they may not need a private banker. But in 10 years, if their wealth grows, they may need a tax planning, portfolio advice, lending, or family office services. So Saxo can bring the front door. It helps Safra Sarasin meet future wealthy clients before they become traditional private banking clients. That is hidden strategy. Now, Saxo also gains from this deal. Being a digital broker is not easy. Competition is intense. There are low-cost trading apps, global brokers, banks improving their own platform, and customer constantly comparing fees. Saxo needs scale, trust, capital, and long-term banking. Safra brings that. It gives Saxo stability, it gives Saxo's private banking credibility, and it may help Saxo's move from being seen only as a trading platform to becoming a part of a bigger digital wealth management story. But the deal also has a risk. The biggest challenge may not be the technology, it may be culture. A private bank and a fintech company move differently. A private bank moves carefully. It protects reputation, trust, and long-term relationship. A fintech moves fast. It experiments, improves products, and pushes innovation. So the real challenge is balance. Once they achieve that balance, nothing can stop them from going immensely. For me, the biggest lesson from this equation is simple. The future of wealth management will not be fully traditional. It will not be fully digital. It will be hybrid. Human trust plus digital speed. A personal advice plus AI support. A private banking relationship plus platform infrastructure. That is what this deal is really about. So when Safra Sarasin bought Saxo, it was not simply buying a trading platform. It was buying a digital engine. It was buying a data. It was buying technology, and maybe the most importantly, it was buying the front door to the next generation of wealth clients. Because in modern finance, the big question is no longer only who manages the money. The bigger question is who owns the client relationship. And increasingly, that relationship began on a screen. So my final view is this. Saxo gave Safra Sarasin something very difficult to build, a proven digital investing platform. And Safra gave Saxos something every fintech eventually needs: trust, stability, and long-term backing. If this combination works, it could become a strong model for the future digital wealth management in Europe. Not a pure private bank, not a pure fintech app, but something in between, a private bank with an advanced digital platform, and maybe that is exactly where the future of wealth management is going. Thank you.